Hey everyone, welcome back to Thought Crime and Keto and Crime. I know this isn't exactly a crime, but it's something that interests me because many ago in college I sold financial products under a licensed insurance agent, which means I had to get my Series 7 and Series 6 brokerage license as well as take the insurance exam. So I kind of got involved in stocks and trading. I do some mutual funds and stocks today. But the whole GameStop debacle, even though it's not technically a crime, it definitely reveals some shady practices, and I just thought I would explain to you exactly what happened there and my take on it. So I hope you enjoy it. Let's get into it. But first, big shout out to my patrons and channel members. Thank you so much. I could not do this without you. Without further ado, let's jump into the GameStop debacle. So let's talk about the first couple players in this. Let's talk about the Wall Street hedge funds. What exactly is a hedge fund? Well, to say it plainly, it is a pool of very wealthy pre-qualified investors. It's would be kind of a investment club plus kind of thing. They have very stringent pre-qualification rules. Usually, those involved have a huge amount of liquid assets, things that they can turn into cash very quickly. Um, Usually, this is reserved for the most wealthy people, usually behind the face of a company or very high net worth individuals. So, like your Bill Gates, your Jeff Bezos, these people would be able to invest in a hedge fund. They also, because they are considered an alternative investment, are not subject to the same kind of regulation that a lot of other types of funds, like mutual funds, even private equity funds, which have more of an open enrollment for the layperson, can get into some of these. Of course, I do mutual funds mostly, so anybody can buy into a mutual fund because you can buy parts of shares. So, but it's the same sort of thing. Think of this as a mutual fund for very high net worth individuals or corporations. And they can do more risky types of betting because there's more, and I say betting because when you get to this level, it is very much betting because these people, because they are not heavily regulated, even though there was some intention after the 2007, 2008, 2009 debacle that they might be more regulated, those rules have still not come to fruition. So they do a lot more risky maneuvers than your average investor could afford to. And what I mean by that, they do something known as stock option trading. And that risky strategy usually involves options trading, which are very different than actually buying stocks because it's a bet on what the price of that stock is going to do. There are two types of options trading. There is a call option, which is basically the right to buy a stock at a certain price because you're expecting the stock to rise in value. So you lock in your right to buy at $10 because you expect it's going to go up to 100. So that's being positive on a stock. The put option, which is kind of what happened here, is the right to sell a stock at a certain price because you expect the price to fall. So I always thought of it on my tests as call up, put down. So that's how I kept them straight. Now, where does GameStop come into this? GameStop, because of its nature of relying on physical selling of games, both in store and some online, but actual physical game discs, they are, kind of like Blockbuster was when Netflix first came out. They haven't quite gotten on the train yet, and it could cost them their entire business. Their stock has been in free fall for several years now. It had gotten down to as low as $4 a share. So, of course, anybody that actually is into options trading might think, okay, that's definitely a stock that's going to go down. The same with like, you've heard about AMC, movie theaters in the pandemic. Those have been falling because people don't go to theaters anymore. Everything's going fully digital streaming in your own house. So, of course, stocks like that, to anybody that sits around and thinks about it, it's pretty obvious. But, your average retail investor, we don't think like that. We just look at, the stocks that we think are going to go up, and we buy them at a certain price, hoping they'll go up. But for hedge funds people that have the money to burn, they do the risky option, and they actually pick a business that they expect to fail or hopes that fail, and they start putting out all of these calls or put options, actually, to lock in their ability to sell the stock at a certain price. So let's imagine we were these hedge funds, and there's a couple of them involved in it, and we want to buy gnomes. We feel that gnomes are on their way out, and the price right now is at $20 a share of a gnome, or $20 a gnome, but we suspect, and imagine this gnome is GameStop, and we suspect that this price is going to continue to fall. So what we do, we go to a commercial broker and basically take out a loan of some gnomes. We buy a gnome at $20, but we don't actually pay for it. We take it on credit. And then we take our gnome and we go over to the retail market and we sell our gnome for the existing price of $20. So now we have $20 for our gnome in hand. And if our bets are correct, the price of the stock is going to continue to fall. And then after whatever terms we worked out with that broker is up, we expect to be able to go back to the market and buy our gnome back at the new price, let's say $10, and then return our gnome to the broker that lent it to us, and then we keep the $10 difference. So it is a right to kind of borrow and then sell and then give back. And that's what these hedge funds were doing with GameStop. They were expecting the price to fall, so they bought it out and they bought a bunch of GameStop stock, or borrowed it. They took it over to the market, they sold it, they pocketed the money, and were expecting to do a quick flip once it started to fall. However, due to the essential work of some common ordinary investors, that didn't quite happen. This can all be traced back to a man by the name of Keith Gill, a 34-year-old Massachusetts man who runs the Roaring Kitty YouTube channel. He started prospecting on GameStop way back in December, and he suspected that it could go up, and that's what he did. He started promoting that on his channel. He's also known as Deep Effing Value on the Reddit board, known as Wall Street Bets, and he put his ideas out there as well. And then when people saw these hedge funds, because they watch them, they started noticing that they were shorting GameStop, and that was enough manipulation to cause the stock to start falling. So it's all simple supply and demand. If a whole bunch of people are shorting the stock, betting against it, it manipulates the Wall Street algorithm and things start to fall. So that's what hedge funds have the power to do because of the power in it. But if people, because no one wants to buy it because they suspect it's going to fall, it keeps falling because there's more supply than there is demand. However, on Wall Street Bets, they said, okay, I believe in GameStop, or they not even really that. They just wanted to screw these big investors, let's be honest, and turn a quick buck because, hey, that's how we're wired. They started putting out invitations for people to buy GameStop. So the more people started to buy it, okay, there's more demand now, and because all these hedge funds are holding a lot of this stock, expecting it to fall, so they can, turn around, buy it back cheap, and then give it back to the broker and pocket the money. Okay, so we have a supply and demand shift, and suddenly there's a lot more demand than supply. The price starts to rise, and you can see now all these hedge funds that are holding all this stock see it go from $20 a share. Our gnome goes from $20 a share up to $50 a share. Now, as they can do one or two things, they can go ahead and cash out and take their $30 per gnome loss to rebuy the stock and give it back to the broker, or they can try a riskier tactic and just hold it, hopefully that the market will correct when people realize that GameStop really isn't worth over $400 a share, and hope that the price will fall, extend their loan terms with the broker, and then still make their profit, or at least save their profit. But because this happened over a period of few months, the stock shot up to way over $400 a share. So you can imagine billions of dollars being lost right now. And then you had apps like Robinhood come out and forbid people to buy these stocks, GameStop, AMC, Bed Bath and Beyond, to essentially help. They said it was just to keep things fair and not to manipulate the market. But what they were really doing is stopping the loss from these hedge funds that they do business with, that are the angel investors in all of these apps, because they have the money to do it. And that's what happened. And that's where we are right now. I checked GameStop this morning. It has fallen to just under $94 a share as of today. So it has been a wild ride from $4 up to over almost $400, then back down to now just under 90. So a lot of the people on this Reddit board have cashed out and made that hundreds of thousands to millions. So I'll be interested to see where this goes in the future. So that's kind of what happened. It's kind of, some everyday investors just screwing with hedge funds. And it worked, and it's become the talk of the town. But I do not recommend this. I still recommend, if I'm going to recommend anything at all, just staying in some very safe mutual funds. But anyway, that's kind of a take on what happened. I suspect there's going to be a lot more regulation on hedge funds now, as it was intended in 2007 through 9. Now with this, they're going to kind of look at how the hedge funds were actually manipulating the market, and there's probably going to be a lot more regulations coming in on hedge funds, I suspect. Anyway, that's my take on it. I hope you enjoyed it, and until next time, keto and crime out.